What's up? It's your boy Austin Rutherford. Today we're talking about the question, can I afford a rental property? I know when I first got started out, I didn't know where to get funding from. I didn't know which banks to turn to. I didn't even know what questions to ask, and that's what we're diving in here today. There's four main ways to buy rental properties, and the good news is no matter where you're at in your journey, no matter if you're just starting out or on your 20th or 50th or 100th deal, there's different types of strategies you need to use for all of those. But there's always a way for you to get started. So the first one is government-backed loans, FHA, conventional VA, Fannie, Freddie loans. These are tremendous ways to get into the business, and they have the best terms. They have a 30-year amortization schedule compared to other ones which have 20 to 25. 30 years, which means your payment is lower, and the interest rate is fixed for 30 years. It will not change for 30 years, unlike other ones which adjust every few years. But you can only use these for 1 to 4 family dwellings. If you go to 5+ units, you cannot use these loans. So 1 to 4 family, tremendous loans to use. But you have to qualify debt to income and credit score. We've done videos that explain exactly how much credit you need, what your debt to income needs to be, but you have to qualify for these loans, and they only lend to individuals. They will not lend to an LLC. So if you have an LLC you're trying to purchase in, they will not lend to an LLC. And you can only get 10 of these, 10 mortgages through Fannie and Freddie. So you can have 10 single family houses, or you can have 10 4-unit houses. So you can have 10 units or 40 units. Big difference here. So for me, my strategy is to buy at least duplexes, or ideally 3 to 4 unit buildings with all 10 of those mortgages and maybe a personal residence. But you can have 10 of these, and then after 10, you can no longer get Fannie or Freddie mortgages. So once you get 10 or before, you can do this before, whatever strategy you prefer, the next type of loan you're gonna go after is a commercial loan. So these are like small banks, credit unions, hedge funds, institutional lenders. These are companies that lend to investors, and they know that they're lending to investors. Most refer to these as something called portfolio loans. Portfolio loans means that they do not sell these mortgages to the government. They keep these mortgages themselves, and they hold them in-house, and that's what the process of going through a commercial loan is. And a couple of the big differences between government-backed loans and commercial loans is that most commercial loans are 20 to 25 years, sometimes 30. You don't see it too often, but 20 to 25 years, meaning that the same amount of money that you owe on a traditional 30-year mortgage, on a 20-year mortgage, your payment is way higher on commercial loans, which again, isn't the end of the world. It still allows you to leverage deals and buy more properties, but your payment's gonna be a little bit higher, but the benefit is you're gonna pay back the loan so much faster. So let's say you own $10 million of real estate on a 30-year mortgage and a 20-year mortgage. You're gonna pay off this way slower, but you're gonna make more cash flow, and 10 years sooner on a 20-year mortgage, you're gonna own $10 million free and clear. And then you can take that 10 million and turn it into whatever you want. So there's benefits and downfalls on both sides. More cash flow today, long-term, more wealth, more equity, more money on your balance sheet at the end of the day, because you're paying your mortgage down faster. And it's adjustable interest rates. Like I said, on conventional Fannie Freddie loans, they have a 30-year fixed mortgage. Most commercial lenders have a 3, 5, 7, or 10-year fixed mortgage, and then it adjusts. So 5 years from now, say you have a 5-rate adjustable ARM, 5 years from now, if the rate went up 3%, you're stuck with that new interest rate. If the rate went down 2%, you're stuck with that interest rate. So it does adjust, meaning that 3 years from now, 5 years from now, when it adjusts up, your payment can be a lot higher than what you hoped it was going to be. Ask me how I learned about adjustable interest rates and 20 to 25 year amortization schedules. Yeah, I learned it the hard way, because I did a deal and I budgeted it on a traditional 30-year fixed mortgage, and that's not what happened. So lesson learned. Deal still makes sense. It just wasn't as good as I thought it was going to be, but now I know, now I understand, and now I'm using commercial loans a lot more in my business. Commercial lenders will lend on single family houses, apartment buildings, commercial buildings, strip malls, retail centers, anything across the board. They'll lend to those types of properties, and they'll lend inside of an LLC. So they'll lend to to your LLC because they know that you're an investor and they understand that. And some banks require a personal guarantee, so they'll lend to your LLC and then ask you to personally guarantee it. And some banks will just lend to the LLC. If the deal is that strong, if the collateral is that powerful, then they won't even make you personally guarantee it. But most banks do make you sign a personal guarantee. And they're gonna give you an infinite amount of loans. You can get as many of these loans as possible because they're not government backed. And you still have to qualify debt to income and cash flow and all those other things. But normally if the deal's great, they'll be a little bit flexible with you because government has strict guidelines. Commercial lenders usually can work with you a little bit. So for me, I got my 10 traditional mortgages and then I started using these commercial loans. The third option is cash. If you have $200,000, you can just pay $200,000 cash for a property. But in my opinion, that's not the best way of running your business because you're not leveraging that money. Let's say you have $200,000 cash, you can buy one property and make $1,000 a month off of it. Or you can take that $200,000 and put 20% down, 20 grand down on 10 properties. And those 10 properties can make you $300 a month. Over 10 properties, that's $3,000 a month compared to one property where you're making $1,000 a month. So you're making 3 times your money when you use leverage, when you use banks, when you use mortgages. You're making 3 times as much, and 20 years, 30 years from then, you'll own all of those properties free and clear. So you got 10 houses on $100,000 a piece. That's $1 million of property you own free and clear, or that one property for 200 grand. So in my opinion, using leverage is so much better because your money can go farther, you can make more money, and you can create more generational wealth. And the last option, number 4, is using private money lenders. Most people use private money lenders to fund their deals to flip and then sell retail. The reason is because most lenders may charge 6, 8, 10, 12, 14% interest, and it's very difficult to make a property cash flow when you're paying that high of an interest rate. But if you can raise money very, very inexpensively, 2, 3, 4, 5, 6%, and use that and put long-term private money on your deals and keep them as rental properties, it's a tremendous model to use because you're still using other people's money. You just have to find the people that you can get to pay that little of an interest rate to. How I use private money in situations like these, basically I buy it with private money, I stabilize it, and then I take it to a bank and refinance it and get all my money back out of it, and then I own the property with no money out of pocket. So if you check the link in the description, I've actually created a video that shows you how you can get free houses. You can get houses for free with $0 out of pocket. So make sure you check that video in the link down there. And while you're down there, you might as well hit that like button, hit that subscribe button so you can get notified on future content. It'd be greatly appreciated. So those are the most used 4 ways of funding rental properties and getting money to fund your deals. There's no right or wrong answer here. There's different benefits for different people. Some people have a boatload of cash they want to use. Other people want to use leverage and use banks. Some people only own 3 properties so they can use government-backed Fannie Freddie loans. Other people's own 30 properties and they can only use commercial lenders. So there's no right or wrong answer here. It's just what fits best for you. And loan terms change all the time. Everything I just said, lenders change that all the time. I'm shooting this during COVID, and what happened is most commercial lenders were lending on 25-year terms. When all this happened, they started lending on 20-year terms, which means the payment is a lot higher. So things change all the time, so you have to stay up to date and continue talking to these lenders and building relationships with them so you know when things change. But the key here is, the big takeaway here is, you have to get started to be able to buy a rental property. Learning all these things doesn't do anything for you. So go out there, start evaluating rental property. I'm going to link a video in the description below that tells you exactly step by step how to analyze and buy a rental property, and it gives you my deal analyzer to see if a rental property is a good deal or not. So make sure you check out that video, but you have to take action and then start getting them financed. So hopefully that was beneficial, brought some clarity, and hopefully you get out there and start buying some rental properties. So until the next one, I'll see you then.